So my name is Abhishek Agarwal, and I'm the founder and CEO of Crowdify. At Crowdify, we are building the backbones of peer-to-peer and crowd lending platforms so that the asset class which is stuck at $20 billion can be a $200 billion next decade. And then you guys who have a lot of money to invest can invest in that and make a lot of money for yourselves. So today in FinTech, it's a huge topic, and I know for most of the technical people, it seems like a single topic. So we will try to cover as much breadth as possible, but it's quite possible that we might not go into deep. For that, you guys can talk to us one-on-one after the session. So the things which we'll cover is peer-to-peer and Bitcoin and machine learning in finance. And we'll try to cover India, China, as well as US. So sort of some perspective about developing world and more perspective about US world. And I let my panelists introduce themselves so that you know what kind of breadth we have. So we'll start with Arvind.
Thanks, Abhishek. Arvind Purushottam. I run the venture investing team within Citi Ventures. Just a brief intro to Citi Ventures. We're Citi's innovation arm, and a big part of what we do is make investments in startup companies that are working in and around financial services. So this includes things that are what you think of as FinTech, in saving, lending, payments, et cetera, but also in technologies that are super important to the financial services world, like cybersecurity, like data, machine learning, customer experience, and so on. So I've been doing this within Citi for about 6.5 years. Before coming to Citi, I was at a firm called Menlo Ventures. I was a general partner there for nearly a decade and grew up as an engineer and proud graduate of IIT Madras, class of '93.
Cool. Awesome. Hey guys, my name is Supes Ranjan. I graduated from IIT Kharagpur in 2000, computer science. Patel Hall, if any Patelians here.
Yay, Patel.
Yeah, Patel. And I am the director of data science and risk engineering at Coinbase. Coinbase is the largest Bitcoin exchange in the US. And we allow people to trade, at the moment, 3 cryptocurrencies: Bitcoins, Litecoins, and Ethereum. Before Coinbase, I worked in ad tech for 5 years, and before that, 6 years in cybersecurity. And prior to that, got my PhD from Rice University.
I'm Anju Patwardhan from IIT Delhi. So if anybody is from Kailash, I see hands from Kailash. I moved to the Bay Area about a year ago. I used to live in Singapore before that for about 20 years. Spent most of my life in banking and Citibank and Standard Chartered Bank, where my last job was as the Global Chief Innovation Officer. And now I work with Creditease, which is a large fintech company from China. It's the largest peer-to-peer marketplace lender in the world, and it's also one of the largest non-bank wealth management and asset management companies in China. And as part of the wealth business, Creditease also has several fund of funds. We invest in venture capital firms, in private equity funds, in real estate funds. And then we also have a FinTech fund of $1 billion, which invests directly in FinTech companies, and a credit fund that buys loan portfolios. So I work with the funds part of Creditease based in Palo Alto. And I'm also a Fulbright visiting scholar at Stanford right now.
Thanks, Anju. So I forgot, I'm an IIT Kharagpur 98 graduate, Patel Hall. So hey, Supes. So prior to doing Crowdify, I was working at Bank of America, managing their $2.4 trillion worth of RMBS portfolio. And that's where sort of peer-to-peer came in because of all the opacity in the RMBS market, if you haven't heard about it. So peer-to-peer seemed like the place which brings all the transparency, and that's why we jumped into that. Before we go there, do people understand peer-to-peer lending and Bitcoins, or should we introduce those two here too? We should? It seems like. OK, so we'll talk about those. So I'll introduce peer-to-peer. I'll let Supes introduce Bitcoin. So peer-to-peer is, if you remember in India, old times, you used to give money to your friends or to Sahukar and all those kind of stuff. So peer-to-peer is a more formalized version of that, where you can give loan to your friends or to other people who are looking for loans. Simple as that. You can call it crowdfunding when you go to do a project. So let's say you say, I want to buy this whole building, and I want to raise money for that. So you can go to a crowdfunding platform, put up a proposal, and if people like it enough, they will all pool together the money and give the money to you. The only friction point which exists is you don't know how creditworthy the borrower is, because nobody knows that, yeah? So the platforms which have evolved, which come up and assess that and tell you what the risk is and what kind of return you should expect. And that's what peer-to-peer and crowdfunding does. So they assess the risk, they tell you what you should be doing, and you, as an investor, can invest in those, or as a borrower, can borrow from those. The beauty about these asset classes, it's completely uncorrelated to stocks and bonds. So if you're concerned about stocks and bonds going up, it's their all-time high, it's a perfect asset class to go after. Can give you 5 to 6% of fixed income returns. So great returns compared to your savings account, which is giving you 0.1% returns. And it's very easy to manage with platforms like ours. So that's the peer-to-peer, and I'll let Soups talk about Bitcoin.
Cool. Yep. So Bitcoin and Ethereum, Litecoins, and there's now hundreds of digital currencies out there, or you can also call them cryptocurrencies. Total market cap of all the cryptocurrencies right now is above $100 billion. And Bitcoin itself is the largest one and the most popular one, around $40 to $45 billion. So what is Bitcoin, or what are these cryptocurrencies really about? They're really a distributed ledger where you're not really entrusting your data with any central database which can be hacked or which can go under when a nation state goes under, right? And Bitcoins and all these cryptocurrencies, the idea is that you incentivize people to actually produce them via a technique called mining. And mining is, at least in the sense for Bitcoin, it's essentially you are spending compute power and electricity in order to compete with lots of miners around the world to solve a cryptographic puzzle, and whoever wins that puzzle gets to actually mine the block, or rather gets to basically encrypt all the transactions into a block, which then gets put together in a ledger. So you can think of the ledger as basically having 2 entries, right? Like the person you debited from and the person you credited to. And there is basically a sequence of these. There's several ledgers in a block, and then there's a sequence of blocks, which is the blockchain. And a lot of times people mix up blockchain with Bitcoin, so I just wanted to clarify. So all these different cryptocurrencies, they have their own blockchains. And Coinbase, as a company, we are the easiest place to buy and sell cryptocurrencies like Bitcoin, Ethereum, and Litecoin. Once you buy these assets, you can actually use them for many purposes. I, for instance, get paid some part of my salary in Bitcoins, right? And then I have a card which is basically linked to my Coinbase wallet. And I can swipe this card anywhere Visa or MasterCard is used. So now if you think about it, 10, 20 years from now, people or kids who are growing up right now, they won't need to go up to Bank of America to sign up for a bank account. They will actually have, a Coinbase wallet. And they would be able to basically pay for goods online, right? You can buy today, like a ticket on Kayak, Expedia using Coinbase. Or you can actually, swipe in the physical world by doing a Bitcoin to USD conversion, right? And that is, I think, the single biggest, or maybe the single biggest use case for Bitcoin would be that you allow people who are unbanked have access to capital.
Cool, thanks. So just 2 things you should remember that. First, it can be divided infinitely. Yeah. So there is no limit to division compared to any dollars, which goes to a cent. And the second part is you don't have to pay any money to transactions. So rather than paying Visa 2 or 3% fees, if you're an entrepreneur, with Bitcoin, pretty much you pay nothing. So for you, if you're looking for microtransactions, micropayments, something like Grameen Bank, for those kind of things, if you want to look into India, Bitcoin is a great thing to have because you don't have to pay transaction costs. So if you have followed FinTech, and I'm not sure how much you have, FinTech has been the hottest field over the last few years and has received the most VC money. So just to kick it off, and I ask the VCs, is it a hype or is there something true to this FinTech whole phenomenon? Arvind, let's start from you.
Sure. I think one of the things that I was mentioning to you when we were talking, Abhishek, is I started doing FinTech investing in early 2011, right? Call it skill or good luck, maybe a little bit of both. And what I recognize and what we recognize as a firm is that the financial services have always been early adopters of technology, right? Whether it's software, infrastructure, networking, you name it, because they recognize very early that IT is a differentiator in financial services. And now what was happening back then and is happening now is that the front end is becoming very digital heavy, right? Very tech heavy. The way people interact with their banks, way companies interact with the people that they bank with has all changed. It's completely online, mobile, et cetera. And so we started to see this influx of capital into FinTech. And by the way, up until that point, financial service was actually a difficult area to invest in, right? VCs actually stayed away from it because of regulations, need for capital, all of those challenges that people all know about. But something changed, right? And over the 2000s, late 2000s, it's changed. People recognized that there was this digitization of financial services happening in a big way. But there were other things that happened that precipitated all of this, which is the financial crisis and everything that happened beyond that, low interest rates, et cetera. And so going to Abhishek's question, the way we think about it is there's sort of obviously, sort of a 1,000 flowers that have been sort of, being cultivated right now. A bunch of them will not work out and they'll go out of business. But there'll be some really, really successful category-defining companies that are being built today, right? I think that people from the technology world, which is probably a lot of us here, get into FinTech because it's interesting. There is a aspect of bringing differentiated technology into financial services. And then you have to figure out the business model, figure out the regulatory aspect of it, figure out capital, all of those things. And then some of them will be really, phenomenally successful. One example from our own portfolio is Square, which a lot of people know about. The company went public, a couple of years ago and doing really well right now, trading at about an $8 billion market cap. Again, a category-defining company. They changed the way people thought about payment acceptance in the retail world. Similarly, if you think about Stripe or Braintree or some of these other companies, Lending Club and some of the P2P marketplaces, I think these companies are changing the industries that they're playing in, even though on paper there's still a small percentage of overall, how big financial services is.
Thanks. Anju, something?
So I agree with what Arvind said, and I would say that we are at very early stages of the FinTech revolution. Most of the investments in the last few years that we've seen have gone, I think about 75% has actually gone into the B2C areas, mostly in peer-to-peer lending, small business lending, balance sheet lending, or on the payments side. And we're just about starting to scratch the surface of how FinTech can facilitate the next stage of financial services. It's only in the last couple of years that the companies are also starting to look at the B2B applications, to look at investment banking, financial markets, trade finance, on the risk management side. So there are huge opportunities. And if you look at the world of banking since the global financial crisis, the banks have been under a lot of pressure in terms of returns. And most people think it's regulations. That's only half the story. The other half is actually pressure from the FinTech companies. And in the last 3 or 4 years, the banks have also realized that it makes sense to partner with the FinTech companies and do things together, which is great because in the end, the symbiotic relationship between banks and FinTech companies helps the consumers. So I think we're going to see more investments and more action going forward.
Great, thanks. So since Anju has already talked about partnership and all, so let's straight away jump to peer-to-peer and crowdfunding part. So everybody has heard about Lending Club. Arvind talked about it. So Lending Club is sort of the pioneer. They started the online lending marketplace. Quite a few have followed on the peer side as well as on the balance sheet side. But last year, they went through a downturn. Their CEO was fired, and they had some issues. And since then, market has sort of taken a sort of breather. It has slowed down in growth and all those kind of stuff. So from an investor perspective or from an entrepreneur perspective, if you think that way, what do you say is working in this marketplace in peer-to-peer and what's not? And how would you change it so that if someone is looking to do a company, what would you go after in the peer-to-peer and sort of crowdfunding space? You can start.
Okay, so first I'm going to correct you.
Okay.
Not correct, add to what you said. Lending Club is the pioneer of marketplace lending in the US, but Credities has been the pioneer globally.
And so that's...
It started 11 years ago, not so well known, but the largest marketplace lender in the world. So my view on this is that you can look at peer-to-peer lending in 2 different ways. There is the consumer part of it, which is like giving personal loans and consolidation of credit card debt, which is good, but it kind of overlaps with what the banks do. The real opportunity in this space, in my view, is on the small business lending. right? Lending to entrepreneurs and small and medium enterprises. And if you look at this landscape, you'd see that the numbers tell us that SME lending globally, it's half the global GDP, it's 2/3 the employment, and yet most small and medium enterprises do not get access to credit from banks. About 70 to 80% do not have access to credit from banks, and about 50% in the US. And that's where peer-to-peer lending or marketplace lending has made a huge difference in the US and in other parts of the world, whether it's China or UK or India or Singapore, or wherever you look at it. China, in terms of numbers, is significantly larger than the US, but even in the US, it's made a big difference. Sometimes people talk of regulatory arbitrage, but when it comes to SME lending, I think it's less of regulatory arbitrage and more of banks not wanting to be in that space for a variety of reasons. And I can understand it's logical. I mean, many years ago when I was with Citi, I used to be the chief credit officer for Asia, and we struggled with SME lending. But now with new technologies, data science, machine learning, it is possible. So I think it's made a huge difference. The numbers are still very small. SME lending by the marketplace lenders or the fintech companies is still less than 5% of overall SME lending in the US, but I really do hope that it'll become a much bigger number. In China, it's much bigger, more because banks don't get into the space. And then in different countries, it's being done differently. UK, it's become very significant, mostly because it's being driven and supported by the regulators and the policymakers.
So just to give you a statistic, so I was talking to a small bank, and they said to underwrite a small business loan, it costs us $4,400. And below 250K, we can't even recover that cost throughout the life of the loan. So anything below 500K, we never touch. And with all the machine learning models and all, these companies can originate them at a few $100s. So that's the pricing difference you're talking about.
Yeah, one thing this was going to add to the whole P2P lending and the lending club topic is last year, about a year and a half ago, that's when Lending Club had some of these issues. What was surprising to me is, we speak to a number of these companies, in terms of becoming equity investors or partnering, or sometimes even on the debt side, right? Or their capital side, because a lot of these guys need to raise capital, they need to be able to securitize to add lending capacity and so on and so forth. In most spaces, if there is a fraud or some situation in one company, the sector is not hit, right? I mean, something happens with some company in semiconductors, the rest of the semiconductor companies are not hit just because somehow they think they're all tainted. But we saw a little bit of that happen with Lending Club, and it was quite frankly surprising, right? Everybody pulled back from quote-unquote fintech, whether you were doing something in real estate or you were doing in P2P lending or small business lending. Everybody pulled back and just wanted to take a breather, as somebody said. I believe that sort of now we're past it. I think that capital is coming back because the fundamental sort of market dynamics have not changed. You still get very little yield through traditional channels. And so what that tells me, and as an investor, when I talk to companies, it sort of sounds a little bit like motherhood and apple pie, but what is the assessment of the management team, right? At the end of the day, especially in the early stages, you just cannot predict what's going to happen like 3, 4, 5 years down the line. So you want to make sure that you're backing a solid team. They care about reputation. They're trustworthy. They're putting the processes in place. And even though there may be a 25-person startup, at least are they thinking about it? Because a lot of the processes you don't need them when you're 25 people, but you need them when you're 250 people, right? And so I think that's kind of where we go to, and this is kind of what we practice as well as a investing arm.
Great. Soups, you have some thoughts?
Yep. So on the topic of peer-to-peer lending and crowdfunding, for instance, so one of the other things that has been really popular recently in 2017 is something called token sales. So I don't know how many of you guys have heard about it, but there are lots of people out there who, for instance, when they are providing their information, like to banks, etc., like uploading their IDs or providing their SSN, etc. Yeah, I as a consumer may not want to provide that same information to every single financial institution that I'm opening an account with, right? So there's a lot of companies which are thinking about disrupting that and saying that, okay, you can actually keep your identity, actually the user keeps it with themselves, we'll just encrypt it and put the hash in the blockchain. And then next time you basically have to sign up with another institution, you just point to that entity in entry in the blockchain, right? So you don't have to provide it multiple times. So that's one of the things that I believe will help when it comes to crowdfunding. And the other thing that is happening is there is basically lots of decentralized apps which are being built. Like people are saying that let's build a decentralized version of social networks. Like Akash is one of them. They are saying let's build a decentralized version of Dropbox. That's IPFS, Filecoin, Siacoin, Storj. Then they're saying let's build a decentralized version of AWS and EC2, which is Golem network tokens. And now, whenever these companies they want to actually, the intention would be, I have to provide an example here, otherwise I think you may lose me here. So suppose I am allowing people to host content on my machine, on my laptop, then I can get paid in this coin, right? And now when these companies they start off by basically selling a whole bunch of tokens to lots of small investors, right? And they're basically trying to kickstart the economy, right? Because they are hoping that once people have these coins, they're actually gonna either use it to actually purchase something of value, or they will actually get paid in that coin as well, right? And so there's this new mechanism which has started, which is token sales, where these companies like Golem or Gnosis and Civic, etc., they are coming out and they're saying, okay, we will actually distribute these tokens to the general public, kind of like crowdfunding or Kickstarter kind of a thing, and we will have they're trying different models like capped or uncapped, and then it's the key distinction is you're not getting a share in the business. This is basically not a security. It's essentially a way to jumpstart the decentralized app.
So just to give you an idea, recently Israeli company did it's called Bankshare, I forgot.
Bancor.
Yeah. In 3 hours, they sold $150 million worth of ICOs. Civic, it's a company based out of Palo Alto. They did their pre-sale last week, and it took them a few hours to sell $33 million worth of ICOs. So the market is huge. If you're building something in blockchain space, going towards crowdfunding, you can raise a lot of money without going to traditional VCs. So regulation is a big part of finance. And any technology guy who's looking to start a fintech is always worried about regulation. So if I'm a technical guy who has an awesome algorithm to find fraud, and I'm trying to launch something, what all regulation I should be worried about and what I should be looking out for? Anju, let's start with you.
There are lots and lots of regulations. So I don't expect anybody to know them by heart, but what I do tell a lot of entrepreneurs and founders is that if you want to do a company in the fintech space, don't underestimate the regulatory complexity. Until 3 to 4 years ago, when I was in the bank and as Chief Innovation Officer, I used to come to the Bay Area often, and we used to look for companies to partner with them for solutions for specific pain points in banking. And one of my biggest frustrations used to be the partly lack of awareness and partly lack of respect for regulations, banking regulations. The general view used to be that the regulations will change, or we will somehow be able to influence changes in regulations. And that has not happened in fintech. So what I see now is a change in mindset. I do find that the companies are much more aware of regulations. In fact, there is this whole new category of companies coming up in the RegTech space, which are trying to help the banks deal with regulatory challenges and also help comply with regulations, help the regulators make their own processes more effective. So that's one thing I always say, that don't underestimate that. The second thing also is that the regulatory environment itself is very different in different countries. Like I've dealt with regulators in Singapore and UK where they have been extremely supportive. We did a project a few years ago using blockchain in the trade finance space, and we were very clear that we didn't want to do that pilot unless the regulators were supportive, because you don't want to do a POC which will never go into production. So we spoke to the regulators in Singapore, and they were extremely supportive. In fact, they co-funded the project and they decided to be on the steering committee with us. We found that the regulators in UK were extremely supportive as well. They've set up regulatory sandboxes in Singapore and in UK, and they've been asking the banks about what help do they need, or how can they collaborate or facilitate partnership across banks. In places like China, it's very different. The fintech sector in China has been led by technology companies. So you hear of companies like Alibaba, Baidu, Tencent, who pretty much own the consumer fintech space, and that was done with implicit regulatory support. And what I mean by that is that while the regulators didn't say it was okay, they also didn't block them. And they have flourished, they've done very well, and partly they've grown so big because the banks were not in that space. You look at India, very different picture. Fintech growth in India a lot of it has been very top-down, very centrally planned, and then executed in partnership with banks and with the technology companies. Whether it's Aadhaar, whether it's the UPI, the payments interface, whether it's the SME banking licenses, payment licenses, it's very driven by the government and the regulators, and the banks have an active role to play, unlike some of the other markets. The place that I find most mind-boggling is the US, right? I think we are at a stage where some of this regulatory uncertainty is starting to hurt the fintech companies, especially in the marketplace lending space. It's like this sword hanging on your head that regulations will come, but you don't know to what extent and how much impact will they have. And maybe it's because there are too many regulators in this space. So I often joke and say that US needs a regulatory sandbox to facilitate collaboration across different regulators, not between banks and regulators. But ultimately, I do feel that it's a good thing. It's a case for proportionate regulation. You can't have same regulations apply to all kinds of entities. So the fintech companies need simplified regulation, but they also need clarity. And I've been doing some work earlier with the San Francisco Federal Reserve and with the regulators in other countries on this space. And ultimately, having regulations and having clarity on what regulations apply is always a positive for the markets. So I do hope that something positive will happen here too.
I hope so too. So we are RIAs and we are governed by SEC here. So I've received enough emails from SEC to audit us, but I wanted something answered like, hey, I have regulatory uncertainty on this. Would you answer that? And it's 3 months and 20 emails and I have not heard back from them. So yeah, I so agree to that.
Yeah.
Arvind, more thoughts on regulation?
No, I completely agree with what Anju said, right? I mean, I see the thing the same way. I think there are certain areas that are very, very highly problematic from a regulation point of view, right? So one area is AML, anti-money laundering. So if you look at a lot of the payments companies, international remittance companies, many of us in this room, I think, can use it because we are sending money back home to India, whatever. But it is a highly, highly problematic area because for banks, as long as, obviously there's a customer and who's sending money to some other destination, and it's our responsibility to know who it is who is sending the money and who the destination is. And if there is a problem, we're responsible for it, right? Because of the Patriot Act and all the other regulations that are out there. And so the AML is one of those reg tech areas that Anju talked about. I think it's actually a very interesting space, and regulation, reg tech is in general an interesting space because of the ability to apply technology to A, improve banks' compliance with it, but B, also reduce operational costs. And so I think it's also, from a startup perspective, an area where if you go to banks saying we're solving something in the regulatory area, I think it's actually easier to get in, right? Because all the banks, all the large banks know that this is a problem. They're looking for solutions. It's a well-defined problem in a sense. You're not trying to sell something new. You're trying to solve an existing problem that they have. And so you'll actually find that people want to talk about regulatory technology.
Just to give you a data point, I forgot there was this European bank, BNP Paribas, another one. They had a $10 billion in fines on AML 2 years back. And then there was another $15 billion in restitution. So AML is a big deal. $10 billion fines you would have never heard. But that's what banks have to pay if they don't comply with that. Anything on AML side or regulation side?
Sure, yeah. So Coinbase, we also have the Demosthenes sword hanging over us in that respect, right? Because we are a Bitcoin company. However, our stance has been that we are thinking of ourselves as the white knight in the space. So we are regulated by FinCEN, and we have money transmission licenses in all the US states that we operate in, which is about 48 right now. So that then comes with meaning that like around 20% of the company, which is about 160 people, around 20% of the company is actually working on compliance or regulation-related work. So one of the things that my team does on machine learning and data science side is actually helping with making those KYC and AML processes much more efficient. And we started with something pretty simple, which was essentially we have to, at certain transaction value, you have to do a very thorough investigation of every account as to, is this account engaging in anything nefarious? Are they, purchasing illegal stuff using the Bitcoins, or are they doing money laundering, et cetera? So we had only ever reviewed, like, let's say, a single-digit % of the accounts, right, which matched a certain pattern. But then we had enough data, so we could actually train a supervised machine learning algorithm, apply it to all the accounts, and then it'll start catching all the zooming into the patterns that the investigators were using, and then we were able to, for instance, file like suspicious activity reports on individuals who were using a platform for illegal stuff much earlier in terms of dollar value than what we used to do when we were using like a high account value lookup type of a system. So that's one example. Machine learning is going to be pretty critical to solving this process problem, right? Yeah.
So to give you an example on my side, so we are sort of trying to take this marketplace from 20 to 200 billion, and we are trying to launch a secondary market so that we can bring liquidity. So if you invest in these kind of assets and you want to get out, you can sell them as you sell stocks. So if you don't know stock trading, every stock you buy, at the end of the day, your ownership is registered with a central authority called DTC. So what regulators have been telling us that the loans would be traded like securities, and you have to settle with DTC. But actually, these crowdfunding platforms manage all their securities, so they never go to DTC. Now, actually, the settlement happens at the crowdfunding platforms. Regulators are saying you have to go to DTC, but DTC does not have any data to settle that. So now we are trying to get all these top clearing houses to do the secondary market with us to clear, and they're like, but you have to go to DTC, and we are like, no, we cannot go to DTC. So it's like there is this uncertainty where we know DTC cannot handle the settlement, platforms can, but regulators are not clear how to handle it. So they have just maintained this uncertainty, which has hindered the growth like crazy, because a lot of big money wants to have their liquidity, and regulators are not clear how to handle that. So I think regulation in terms of understanding is way behind too. Like SEC called us to say that, hey, we want to audit you not because we want to see what you're doing, but because you want to learn about the asset class. I'm like, that is just weird, yeah? Like, if you don't know about the asset class, how would you regulate us? And they're like, yeah, we'll learn about it and then regulate you. I'm like, okay, fine. So that's the scene of regulation, not to dishearten you, but just be careful about the regulatory part. So the other thing which a lot of us are thinking, we are based out of US. There's companies like Google and Facebook started here, and they're doing great in India. Can we build a worldwide enterprise in finance where we start here and then take it to India or China? So there is something called global FinTech enterprise. Anju?
My view on that is that if you look at US or China, and maybe India to a lesser extent, but these three countries do have sufficient scale, consumer demand, and market size for FinTech companies to get to a critical scale and become commercially viable, profitable, become unicorns. In fact, China, in terms of dollar value, has some of the largest FinTech companies in the world. But if you go outside of these three countries, I find that there is a lot of local regulatory complexity. The infrastructure varies very significantly across countries. You may have bureaus, you may not have credit bureaus. There are different KYC requirements, AML requirements. Everything is very, very different in each of these markets. And therefore, if the solutions that you build in one market don't generally apply in other markets. There are exceptions, like if you're in cybersecurity, for example, right? You could build a solution which can be deployed in multiple countries. But if you're trying to go after specific financial services areas like payments or lending or robo-advisory, or any of those very specific products, it's hard to build a global solution. And the local regulatory complexity and local infrastructure variances make it very difficult. So I always say the best way to do it is to partner with a bank in that market, because the banks have the local licenses, they have the regulatory know-how, but they don't know how to build good technology.
Arvind, since Citi is the global organization.
Yeah, we agree with Anju. I think that even more so, when you're selling software to multiple countries, you have to localize different languages and so on and so forth. But it's a much deeper thing when it comes to financial services, right? I think that the regulatory aspect is one. The nature of the market is different. The market dynamics are different. I mean, so there's so many different things to worry about. Maybe the EU is somewhat more uniform across different countries, so that's a good geography in addition to the ones that you were mentioning, Anju. But otherwise, you have to localize. I think you have to localize, and it's hard to build a global company in that way. So some of the guys like TransferWise or Coinbase or others who are doing this international, I mean, that's international by design. So I think that's actually, to some extent, maybe the first experiments of how you build a global fintech in that way.
So just to give you an example, so we have a machine learning model on our side, which does awesome prediction here for loan performance. So I knew someone at UniCredit, and they reached out to us. So they said, hey, can we use your model to do our modeling? And they are Italian bank, so they're the biggest Italian bank, and our model performed terribly. So I've talked to, and it would seem like Europe would be, but it did not. And I've talked to enough Indian companies and few in Jakarta. Our model does not work at all. Because they all have, like India has CIBIL score, which is so different, and it doesn't even cover everybody and most of things. Jakarta has, again, 20% population covered by some scoring. In Italy, the difference is because of government regulations, loans are given very differently, and they're not foreclosed and all those kind of stuff. So there's a very different regulatory environment. So a model which works awesome here does not work in 3 markets which we have tried. So maybe you can use the same algorithm, maybe a similar random forest, but again, you have to train the model completely differently. You might have different leaves which will make it through. So very difficult to even apply similar models across.
What I used to tell some of the companies was that, if you're a large bank like Citi in whatever number of countries, used to be 100, now less, right? But, if you want to integrate with local peer-to-peer lenders, each integration is a difficult process because each company is built differently. So I used to say that I wish somebody could build an in-between company like an API layer or something so that it would talk to our system, and then we could talk to one lender in Jakarta and one in Thailand and one in China, or pick the best in each market. I don't think anybody's done it yet.
I don't think it's possible.
Could be done on the blockchain.
Okay, so from that, let's move to blockchain. So we did talk about Bitcoin. Ethereum has been up 5,000% over the last 6 months, if nobody has followed that. So if you invested like a few $100s, that's a few $100,000 now. Mm-hmm. So it's a lot of money. There's a lot of applications being built, Civic being one of them, which is, we talked about, it's digital identity management solution built on blockchain, quite a few cryptocurrencies. So is there a real business? I know we have talked about this, but is there a real business, or is this all hype and it'll go away? Soups?
Yeah, so I'm vested in it. So, but even if I took a subjective view, an objective view, I would say, yeah, there is definitely real businesses to be built here, right? So even today, for instance, I can send money to my parents in India using Bitcoin. So if they have a Bitcoin wallet, so Coin and ZPay, they are the most popular Bitcoin wallets in India. Coinbase doesn't operate there just yet. So I can send money much faster than the traditional remittance mechanisms, TransferWise, etc. And they will have the money within like 10 minutes if I use Bitcoin as the blockchain. If I used Ethereum, then it would be a few seconds, right? That's one of the biggest use cases. Then of course, a merchant can use Bitcoins to be paid or to sell its goods, right? So Coinbase also has a merchant API, so you can actually buy tickets on Kayak Expedia, or you can buy a desktop on Dell using Bitcoins. Now the interesting thing here is that Bitcoin is a private key, 128 bits. The private key, whoever holds it, they hold it, right? There's no disputing it. If you think about credit card, right? The number on the card, right? It's printed, you lose it, somebody can scam you. So with merchants who are accepting Bitcoins, they can actually accept Bitcoin as a payment mechanism without any chargeback risk, right? because they can be sure that the person who is buying the goods from them with their Bitcoin is really the owner of the Bitcoin, right? It's like cash. So that's another big use case.
Yeah, so basically fraud losses goes to zero. So I've been told that I have just 3 minutes left. So we'll move, or 2 minutes left. So we'll move to Q&A. Sorry about that, I have to jump. So anybody has any questions? Okay, let's start from here.
I have a question on Bitcoin. I mean, I'm pretty new to the concept, but is there any like a exchange rate or something? Let's say I send a Bitcoin to India, right? So I mean, it's equivalent to like $2,500 or something, right? One Bitcoin.
Right.
So, but then is it equivalent to similar amount in India in terms of the exchange rate, or how does that work?
Oh yeah, it's actually very interesting. It's fascinating. So you remember when the demonetization happened back in November? So at that time, the Bitcoin to INR rate was actually 30% premium. So you could actually send Bitcoins and you could get 30% more INR in India. So it's because like just the different demand and supply in different countries makes it different, right? Like even right now, you can go to sites like coinmarketcap.com. And you will see that the recent price increase in Bitcoin has recently just come from Korea and Japan, at least the last couple of months. And over there, it trades at a much higher premium, again, like 10-20% premium. So, yeah. But then the arbitrageurs, they move in, and then they neutralize the market eventually, right?
So, yeah. Go ahead.
I have 2 questions for Soups.
I think. Go ahead.
Yeah, I have 2 questions for Soups. So one is there a concern to the success of cryptocurrency that more and more people are making money off it instead of using it to actually purchase services?
So there are lots of people who are just holding on to it. So in Bitcoin, there's a meme called hodlers or hodlers, right? But there's lots of people also who are using it to actually buy goods. So we, for instance, at Coinbase, we employ contractors all around the world, and we have contractors in South Korea, Australia, Indonesia, etc., and they get paid in Bitcoins, right? And there's other companies, which are just providing a white label solution so that you can get paid in Bitcoins. So there's lots and lots of use cases coming up. We won't see them being accepted in the physical world just yet, but there's quite a lot of things you can buy using Bitcoins online. Yeah.
Okay. Last question, you mentioned that a part of your salary comes in Bitcoin. So how does the taxation work?
Yeah, so it's taxed as the equivalent USD at the time of, at the time I get it. So the taxation laws don't change at all.
Yeah, go ahead.
For personal income taxes, yeah.
So someone in the back was asking. Shikhar is coming, so.
Can I ask you a tax-related question?
Yeah.
So if the value of your Bitcoin increases, do you need to, and so do you owe capital gains taxes?
You do. Yep.
So Bitcoin is treated as an asset.
Right.
So
yeah, and then if the similar rules apply. So if it's more than a year, then it's.
Go ahead.
David Rakit, Kharagpur, 1981. We are in the process of launching a FinTech company, and we're in the MVP stage. And I have a couple of questions. Perhaps you guys could clarify that. We are into the foreign exchange market. So here we'll be collecting the money in US dollar and delivering in other currencies such as Singapore dollar or Japanese yen. Now, will we be affected by the SEC and FinCEN and all those regulators? And do we need a banking license in America? And do we need a banking license in the respective countries that we will be operating? Because the delivery channels will be different. And is it better that you advise us to do the delivery channels through a third party rather than we directly get involved?
So just top of my mind, and I'll ask Arvind. So if you're doing money transfer internationally, you need KYC done everywhere.
So that's what my other
and
question,
AML,
KYC and
AML. Definitely because you're transferring money, so you have to have a partnership with the bank because you're doing the money transactions and all. So,
no, but the money will not be transferred.
No, but you're taking money, transferring Bitcoin, and then doing that money.
Correct.
Yeah. So you have to do all the regulation as if you're doing normal money. You cannot get away with any regulation with that.
Okay.
100%.
KYC and
everything.
AML.
So as if you are an FX company, whatever regulation they have to do, you have to follow each and every regulation. None of them goes away.
Okay. And if we move on to cryptocurrency later on?
So unless until if you're not touching fiat, then also you would, in theory, because money laundering can happen, and
Right.
you can support terrorist networks. So from my gut feeling, whenever you're transferring international money, if you're not doing AML and KYC, you will definitely fall into that trap, and in the long run, you will be hurt much badly. And it's not about losing money; it's about going to jail.
Okay.
So,
Thank you very
so
much.
think it
Thank you
that
very much for the clarification.
Okay, let's last one. Okay, sorry, whosoever.
Mukund Sivaraman, IIT Delhi. You guys talked about Bitcoin, cryptocurrencies, and peer-to-peer lending and all that cool stuff. Just wondering, this is an existential threat to big banks and, in the case of currencies, governments, right? So are you getting a lot of pushback, blowback, changing the rules of the game as you invent stuff? And at what point are you, or if not, at what point will you guys be big enough that the banks or the governments are going to come in and try to kill you guys?
I'll let Arvind answer that.
Well, listen, I think the existential threat is a little overblown,
Yeah,
frankly. And what I would say, I think Anju referred to it before, right? I think that what I see is that the banks have actually kicked into gear to actually partner with a lot of these startups, to invest like we do, to learn in other ways and bring those technologies and capabilities in, right? I think if you just sort of, there's a price to pay for being a big bank, right? We've seen that in the last 5 or 6 years, but they also enjoy some benefits because of all the legacy and the relationship with regulators and everything else that's happened there. Access to cheap capital, all of those advantages are there. So could it be an existential threat in the future? Potentially for individual businesses, right? Large banks have many different businesses across many countries, and so individual businesses, individual countries, it could be a threat. But I would say the reverse, right? Which is, I think the big banks are also good about recognizing this, have been about recognizing it and working with startups and working with technologists to actually get smarter and introduce new products and services that simplify people's lives. I think that people have gotten the message.
I don't have permission, actually, so I can. Okay, go ahead, finish it up.
I'm Paras from IIT Kharagpur. So I want to know from Anju and you, like, how do you kind of give loans to people who are new to credit? Like, how do you evaluate them?
So you're talking thin files and.
Thin files, yes.
Okay, so I can answer that. A lot of startups are trying to do that. So there is a small leeway around regulation, or at least they found a loophole. It's not a loophole, actually. But basically, we look at your jobs and other stuff and try to see if we can find an alternate indicator which tells us that. Like SoFi started doing that, where they were looking at your college degrees and all. If you're going to MIT, probably you are a good credit risk, so I'll give you the loan. There is another company called Earnest, which is trying to do the same thing. If you're coming out fresh out of college, or something like that, you don't have any credit history. So there are other indicators which we can use.
So I have founded such a company which judges you on based of psycholinguistic questions, your intentions
So
to
just
pay back.
regulators have not approved anything which is not credit related. So if you're using social data, anything like that for lending, it's not approved by regulators in US. So you cannot use that as a company.
Once you scale a company, you have to look out for something called disparate impact. So you might run a test which doesn't take into account gender, race, any of those things. But then they look at the results of what you've done, and then you have to prove to regulators that it's not, discriminating, right? And so just watch out for that.
But it's not approved. Every time people have gone with alternate, it has been disapproved by regulators. So if you're trying to do anything alternate, like social data, big data, like what kind of car you own, it's very discriminatory because it is inherently discriminatory, so it's never been approved. No, so even if we approve, regulators will not. Sorry, that's all we have time for. We can talk individually. Thanks a lot.